Again, GM shares are rising on earnings, a sign that maybe the auto giant strategy of moving slow and steady is helping the company in the EV race. Now, GM saying that it still sees, quote, positive variable profit in its EV business in the second half of this year as it projects to sell around 200,000 EVs by the end of the year. Our next guest has named GM one of the best positioned OEMs long term. We want to bring in Tom Narayan. He is RBC Capital's global auto analyst. Tom, it's great to have you here. So talk to us just about your takeaway from these results. Again, GM is cutting costs. The pricing strategy seems to be helping. So how does that then position GM amongst its rivals here for the remainder of the year?
Yeah, it positions it very well. I mean, we're dealing with an industry where pure play EVs are going to be really challenged with the EV slowdown. So you kind of want to have ICE exposure, which they do in spades, right, with SUVs and pickup trucks. But at the same time, you want to have EV exposure when demand comes in. Luckily, these guys slowed their roll, if you will, on BEVs, and they're going to come in, they believe, in the back half of the year with a lot of launches. And they're building their own batteries with the help of LG, so they'll get those IRA credits, which, by the way, is a big part of why they think they'll get to the mid-single-digit EV margins next year. There's only two companies really doing this. It's them and Tesla that'll get these IRA benefits. So, yeah, it's all about EVs and how they approach them, slowing initially, unlike Ford perhaps, and coming in, hopefully, for their sake, when demand eventually comes back. The open question, obviously, is will demand come back in H2 for EVs? A lot of those 200 to 300,000 EVs are Equinoxes and Blazers. Those are more lower priced. That's where the problem point is. But they're hoping that they can get that $7,500 credit because they're producing batteries with Ultium in the US, and that should help spur demand because they can lower pricing.
Tom, great to speak with you. I'm interested in how many times you've mentioned EVs in your first answer, because my read on this earnings print was that they are winning because they are not over-investing in EVs. They're focusing on the core fundamentals that have always made them a go-to company. Can you explain why I'm wrong?
No, you're absolutely right. The Q1 beat was largely ICE driven, right? The EVs that they sold were the higher end EVs, right? The Lyrics, et cetera, where you saw costs come down by $12,000 year over year. But there's still the strong suit was the pickup trucks and SUVs, the ICEs. So, yeah, you're absolutely right. The reason why we bring up EVs is that's where the strength should come in as they scale. 60% of the 60 basis point improvement in margins is coming from pure scale. And so if they're able to hit the higher end, let's say of the 200 to 300,000 EVs by the end of the year, that helps a lot. But yeah, the margin strength in Q1 was, to your point, largely because of the ICEs and their ability to hold on and keep pricing higher.
Tom, our executive editor, Brian Zazi, he was able to speak with GM's CFO, Paul Jacobson, earlier this morning and asked him about the pricing strategy here, what GM is seeing on that front. I want to play a quick soundbite and then get your reaction on the other side.
What I'm really proud of is that the team has been able to do it while staying consistent on pricing. Historically in this business, a lot of share was traded back and forth with price wars.
So, Tom, taking into account what Paul was just saying there to Brian Zazi, how does this compare to what Tesla is doing, what the other competitors are doing? And then also going back to, it sounds like it's also reemphasizing your point just about why GM is better positioned at this juncture.
Yeah, because the pricing is really happening at the EV front. If you look at where inventories are building, I think it's 80 days for EVs in the US, whereas for ICEs, it's only like 50 to 60 days, right? So demand slowing down for EVs means you have to cut pricing to get these off these dealerships and off the lots. So the ICEs are able to hold on to pricing longer because demand is shifting back towards them. So, yeah, it's totally consistent. We're seeing that also with Stellantis, the other name I think is really well positioned with the legacy OEMs in the U.S. because they're able to hold on to price because they sell ICEs and plug-in hybrids to the expense, unfortunately, for these pure play EVs and currently for Tesla.
Tom, let's end on some potential bad news for GM. We've heard a lot of bad news this morning about the impact of China on names like Tesla and, of course, Apple. Is that the biggest risk for them moving forward, or is it something else?
No, I mean, there were some questions on the call today on China. They're exposed there, but it's not really a big driver for them as much as it is for Tesla. The bad news, I would say, is again this 200 to 300,000 full electrics that they're planning on producing this year. They're only at the beginning of that this year. What if the Equinoxes and Blazers, that's kind of the more lower priced cars, what if there isn't enough demand for those and they have to really cut pricing, or they just don't sell as many? We mentioned scale at the beginning. If you don't sell enough, that hurts your EV margin. So I really do think it comes down to them being able to sell those high volume EVs, Equinox and Blazer. We're just at the beginning of that. We got to see if really people are willing to take the plunge and buy their EVs.
Really good points, Tom. Thank you so much for joining us to break this down. Really appreciate it. That was Tom Narayan, RBC Capital Global's auto analyst.